Welcome to this, our last tip in our cash flow series. We hope that you've been able to use any number of the tips along the way in order to start making some real improvements to the cash flow in your small business. I'm Cherie, and for over 15 years, I've helped hundreds of small business owners to start, build, manage, and grow their businesses in such a way that led to a meaningful outcome for themselves and families, their team members, and the wider community, and we'd love to help you do the same. So tip number 14, our last tip in this series, is alternative financing and funding. It is my belief that any type of funding can be classified in two ways, reliable or non-reliable, and internal or external. I talk about reliable and non-reliable is whether you can count on the money when you need it or whether it's contingent upon something else. Your choice of funding will depend upon whether you need a reliable source or whether you can absorb some potential variability in whether that money comes in or not. What do I mean by that? Some sources of funding are likely to happen, like asset loans for business equipment or a mortgage backing to buy a business. Whereas some sources are completely dependent upon circumstances outside of your control, such as grants and prize money. You cannot run a business dependent entirely on financing where circumstances are outside of your control. This is not a reliable source of funding. It's a bonus, or it will help you achieve a certain objective. Now, that isn't to say that there aren't any number of government programs that will pay out once eligibility requirements are met. Once you've assured yourself of eligibility and you've met the conditions of the program, then the nature of that funding becomes reliable, as it is something that you can count on. The second classification is between internal funding and external funding. Internal funding is basically the money generated from customers. There are a number of stories of major brands who got their companies up and running by using customer cash. There is a cap on the growth that can be achieved solely using internally generated cash flow though. There's even a specific formula that you can use to work out that growth number. That's a calculator that's available in our resource section. External funding is money coming in from outside the organisation. The most commonly recognised of these would be loans, whether they be from banks, credit supplies, friends and family. But there are a number of other ways to bring in the skills and expertise that you need other than just cash, and that's what we're going to talk about today. On the money meter, this is firmly on the money in side. It has a high impact because you cannot run a business without funding or access to cash or capital. What we propose here though is to think outside the box and into a number of different ways that you can get access to what you need without the need for just cash. In the past, the ease to implement activities surrounding alternative funding would have been quite high. Now we classify it as a medium. So even though we make it easier to find and put together a deal, the reality is that there is still a lot of legwork and due diligence that needs to go into making sure that the deal is a good fit for you and your business. So what does alternative investment or funding actually mean? Well, let's look at the different forms of funding. The first form is an equity type of investment. This is something that you might be familiar with. It's the ownership stake in your business. Equity investments are those where you're exchanging ownership in your business for money or services. Although you're often better to have 50% of something than 100% of nothing, your choice of partner can have a significant bearing on the decision-making process in your business, so the decision to offer equity shouldn't be taken lightly. Let's look at the two different types here, co-founder and equity. Now, a co-founder is you might have fantastic skills in one area and need to bring strength to a different area in the business, and then you might consider taking on a co-founder who has those skills. You can always hire on for a role, but that will generally not bring with it the passion and the incentive to really get the job done. Whereas if you find a co-founder that they're just as committed to the vision as you are, you can produce some exceptional results. A co-founder is somebody who will take a share in the equity of the business based upon the vision for the future. The equity is about the exchange of ownership equity for services performed or for bringing in strong relationships to the business to enable it to grow into the future. For an existing company, there are strict capital raising requirements by various regulatory bodies, for example, ASIC or the SEC. This next type of investment would be termed an interest. This just means that there's an interest in the outcome or the result. It means there might not be equity in the business, but rather a stake in the outcome represented as either percentage of gross or a share in the net profit of that product line or business unit. The two major types of interest funding are joint venture and strategic partnership. A joint venture is generally a business entity that's created by two or more parties, and it's generally characterized by a shared ownership, shared returns and risk, and shared management. It's generally built for the long term and is a more formal arrangement than a strategic partnership. Because there might be equity involved in a joint venture, they might establish a new entity. You'd need to have a stronger agreement in place, and we would seek to guide you through the common questions in building your draft letter of intent to help you build the foundation of that strong relationship. A strategic partnership is where two separate parties come together to pursue a win-win arrangement while keeping the businesses separate. This collaboration may only be for a single project, or it might have a long-term view. It's relatively informal and can be easily established once the objectives of the venture have been set out and agreed to. Joint ventures and strategic partnerships are a powerful growth lever that can be used in your business. Both seek to capitalize on the sunk cost of customer acquisition by one business and use it to the benefit of both businesses by coming up with new opportunities. You can choose to do this in any number of ways, and there's no set format, so you're limited only by your imagination on how to put a deal together. The other type is a catch-all for areas of funding that don't neatly fit into equity or interest. These are barter and mentor relationships, along with crowdfunding. With barter, no cash is no problem. Barter is the exchange of goods and services without using money. Barter will allow you to exchange your products, services, time and talent instead of trading cash. Why is this useful? Because you make a markup on the products that you sell, so you're now acquiring the exchanged goods at your cost. Now, a mentor is not a coach or trainer. A mentor relationship is a two-way relationship that grows where you share knowledge and expertise, networks, and you can work on the development of a solid set of soft skills that will take you far in both business and life. A mentor is someone who can give you a head start towards real success strategies because they've done it before. They'll provide guidance and advice and give you alternative perspectives, all while moving forward and making progress. Crowdfunding is another source of alternative funding. It definitely has its place, and there is a lot of thought that needs to go into a crowdfunding campaign. There are different types of crowdfunding, so you can crowdfund for equity, but generally you might crowdfund to finance your business via a loan, donation, or by exchanging money for rewards. Some of these crowdfunding sites will provide an incredibly valuable way for you to market test your product on real life customers, but if you do that, be sure that you have the product and it's done in an ethical way. The last ones here are just variations on cold hard cash. If you're spending your cash, then you want to know that you're getting the best value for your money. And this doesn't mean the cheapest here, the focus is always on value. The 60/40 quote function will allow you to put your job out to the 60/40 community to find who you need quickly. Our quote project asks you a lot of questions about what it is that you're looking for so that we can help you build a better brief for your provider. A brief is simply instructions and information that enables the provider to see clearly what it is that you're after so that they can give you a quote with context, and it enables you to more easily compare their services with others, and so the likelihood of unexpected extras popping up or multiple phone calls or emails to provide extra information is minimized. The second option is delayed or staged payment terms. Now, this is an arrangement where you agree with the provider to get the work done, however you can pay for that work over a stage linked to the project milestones or at an alternative time frame, but it's outside the provider's ordinary terms of doing business. Now, special offers are members-only specials that our providers have created that are available under each factor and set to achieve a set task. These will literally save you hundreds of dollars for the packaged offers that will help get you on your way. You can access these in the hub, and as 60/40 grows, so will the different types of special offers that providers will put up. So now you know the different ways you can use alternative funding to get done what you need in your business. Let's imagine for a moment if you had unlimited access to funding. How would you change your approach to your small business? What would you do differently? Who would you like to bring on to build, manage, or grow your business with you? Thinking about the different types of alternative funding, how do you think you could use these in your business? Let us know what you came up with on Facebook, or connect with us via LinkedIn and use the hashtag GrowWith6040. We'd love to hear more about your plans, and if you aren't quite sure how you could use it, check out our content with case studies and different ways that it's been done already. Let's unlock those hidden riches in your business because you're only limited by your imagination. The YouTube extra content around alternative funding is going to cover these three things. The first is a big one, and it's structural restriction. Your choice of business structure may restrict the options that you have to put together alternative funding deals. For example, if you're a sole trader or a partnership, you won't be able to offer equity. The only type of entity that can offer equity will be a company. And even with that, there's different types of companies. So if you're thinking about this, please get expert assistance from a legal professional or accountant. Now, equity issues come with their own legal issues. This is a heavily regulated area in both the offer, how it's made, who it's made to, and the format of the offer, among many other things. There can be large penalties for getting it wrong. This is a quite complex area of law, and at 60/40 we have a whole division that looks after that so that you can get the help that you need to make equity offers a reality. One of the hardest parts is the legwork it will take for you to find and put together a deal. At 60/40, we've simplified the process completely. You can use our platform to find someone looking for a match of your preferred type of alternative funding. So how does that work? At 60/40, we provide a 3-step framework for unlocking the hidden wealth in your business. In any business, there will be any number of upside leverage opportunities just waiting to be found. Now, the opportunity is where small business owners and entrepreneurs get to list their ideas so that other business owners or service professionals can review them to make an offer. Your idea might be looking for any type of alternative funding, such as barter, mentorship, deferred payment, quote, co-founder, joint venture, or strategic partnership. During the offer phase, there will likely be questions, and that will lead to firm negotiations that cover things like milestones, governance, and desired end results. After the negotiation comes the agreement. This documents the negotiated deal, placing everyone on the same page, reducing the expectation gap of what you think is going to happen to what actually is going to happen. By building in milestones, there's no ugly surprises at the end. There's just clear and documented terms and checkpoints along the way. Alternative funding is truly one of my most favourite topics, and I literally could talk all day about it and the doors that it can open for small business. So while we don't have all day now, we will have a lot of content around this topic going up regularly on our site and on our social channels. So make sure that you connect with us and send us any questions that you might have. So now this brings us to the end of our cash flow series, and we hope that you've found it useful and that you've been able to take action on a few of the steps to start seeing improvement in your small business cash flow. If you haven't already, please sign up for our cash flow tips just so that you can get free access to all of the worksheets that we've mentioned throughout this series. Let's build better lives through small business and entrepreneurship, and let's all make great things happen. Thanks for listening. This has been awesome, and here's to us all having an amazing rest of the day.